St. James's Place Polaris Fund, I get a lot of complaints about this, so let's dive a little bit deeper into it and what problems we have. I don't actually mind so much that it's 0% return over the space of 12 months. That in and of itself is not a problem until you look at what those 12 months were. 2023, one of the best years the market has had since the Second World War. Okay, at least they sort of made up for it once you get into January and 2024, which again was a phenomenal year for the market. Well, not really. They lagged behind a major index like the S&P. What St. James's Place have done with Polaris by giving it a sexy name is that they've been able to wipe the slate clean, but there's a couple of problems. So you don't have a 3-year record. You also don't get to see how it did in that awful year of 2022 when the markets were down. Problematic? Of course it is. 8.7% return 2024, 9, 2023. That's really poor in absolute terms, given that 4% comes from bank interest. So your risk premium, the reward you're getting for taking risk, is only an extra 4%. You might think, well, that's fine. Okay, well, let's just look at a simple benchmark like a Microsoft. You know, well, that's not fair. Well, really? Because it's bloody easy to see what it does all the time. And I don't mean easy as in Goldman Sachs say buy, Citigroup say buy. You might say, well, that's hindsight. Morgan Stanley say buy. Well, it's not really. We're going all the way back to 2015 here. And if you're not able to do anything even comparable to that, then why aren't your clients just having one or two individual stocks themselves? Here's a problem. They're double dipping on fees. How are they doing that? This, by the way, is great sales literature. Oh, we've got a bit of everything. Makes the client feel as if you must be incredibly clever. Look how diversified we are geographically and through sectors. Well, that's a bit bloody useless if your returns aren't there. And I'll tell you why the problem of returns comes in. St. James's Place has a habit of constantly double dipping in fees. So they have the Polaris Fund charges fees, which then invests in a bunch of other, yes, you guessed it, St. James's Place funds. They double dip on those fees. Are they telling you what the total fees are, or are they only telling you the top level fees? Are they telling you that they're holdings and they're paying themselves those fees? Now, here's another problem with doing it this way, other than the layering of fees, which is a major problem. Sooner or later, the regulator's going to crack down on this. Here's another problem. See that where it says value and this says quality? Well, why aren't they all just value quality growth companies? Okay, why is value separate to growth? Well, so they can sell you more product, charge more fees. Surely, an undervalued company should be one that's also growing, as the academic literature shows. They're better